You are watching Benzinga Live. All right, everybody, welcome to a special edition of Benzinga Live. I don't need to tell you what the top story this week has been. That has been, of course, the resurgence of the meme stock rally and the subsequent fall in the last couple of days. But to start the week, you had AMC and GameStop each going up more than 100%. We thought, we've got some people we got to reach out to and talk about this with. We have Andrew Leff from Citron Research hanging out backstage with us. We're also going to talk to Rod Alzman, founder of GMEDD.com, in a few minutes. Again, just to help us make sense of all of this going on, because let's face it, a lot of it might not make that much sense right now. So without further ado, let's go ahead and welcome our first special guest of the day, Miss.
What's up, Andrew?
How's everybody doing?
Us. Doing well. We did this interview in 2021 when GameStop started moving. I think the stock was like 14, 15 bucks up from, I don't know, like 2 or 5 or something along those lines. It was the first time that I had ever gotten doxxed. My internet everywhere, or my address everywhere on the internet. Pizzas were being ordered and shipped to my mom's house. You had that too?
Oh God, all the time. Yeah.
Yeah, it was a good one. It was a good, creative.
Well, they're
go ahead.
I was going to say they're called apes for a reason. No one ever said we're a civilized bunch.
Yes, and our interview made it into the documentaries on Netflix, on Amazon Prime, and on to Hulu.
It did.
Yeah, it was the first time my in-laws thought it was cool. Actually, they were like organically watching it, and they saw me pop up on the screen, and I made it in their eyes, I think. So.
Did you have anyone play you in the Dumb Money movie, the Seth Rogen one?
No, I didn't. I was Ben. I didn't speak to him when he wrote the book. I thought he wrote it from such a poor perspective. I really thought that whole story was told poorly. I guess it was entertaining, but it wasn't fair. Ben Mesrick. And when he started to write the book, I wouldn't really speak to him because I just didn't like the way he was telling the story.
Got it. He's the same one that wrote, was it the Bringing Down the House, the book based on 21?
He was, yes.
Okay, I think that was.
He was making it as if, and the story still goes down as if the short sellers were the bad guys.
Well, okay, so let's talk, because that was, one of the questions I wanted to ask you about this. So I guess let's start with the most recent, this week, the price action. We were talking before you hopped on about what caused this, because the media is going with the story that Roaring Kitty reignited this whole rally Sunday night by posting these memes. He posted the first meme 8 p.m. on Sunday night of just this guy leaning up in his chair. The next thing you know, GameStop's taking off. But GameStop had actually started rallying a little bit before that. I mean, what can we attribute this to? What do you think was going on? Do you think it just got overextended to the downside?
A complete correlation versus causation thing. I don't even know if people remember when GameStop started the first time. It wasn't because of Roaring Kitty. He was there. He put out a video. I think you can still see his video. It's still attached to his Twitter about why GameStop's ready to turn the corner as a company. It was all his analysis on the company, which all turned out nothing really happened, right? And then obviously the stock moved, and they had to attribute it to something. So he became the poster child, and I guess the rest is movie folklore. This time, the stock was up 100%. It went from like 10 to 20 over the past month. And it was moving up. And then all of a sudden he put out, or maybe, as they said, I'm hearing now, somebody might have hijacked his Twitter, whatever it is. On the Roaring Kitty Twitter was that weird leaning forward meme. And I'm very skeptical that caused the trading that we saw. But at the same time, there wasn't any crazy squeeze. It wasn't so highly shorted. I think as of yesterday, the borrow rate was 2.5%, whatever you wanted to borrow. And I really didn't see on. So it quite a different dynamic than the first time around.
So would you ever look at GameStop again as a short opportunity? Like when we see madness that happens in this past week, is that something you'd consider?
Of course. Listen, it's always a good opportunity with stocks. Obviously, the difference is now if I'm going to short GameStop over the past few days, which I have, you do it judiciously. You expect it to go higher. You realize maybe I'll just sell the call premium and take that in. And you say, okay, if it goes lower, I'll make money, but by no means am I going to make a crazy amount of money. If it goes higher, I'll lose money, but by no means am I going to lose a crazy amount of money.
Because your risk is defined in that way, and instead of shorting it outright.
You're just judicious. I mean, when the stock hit $75 3 days ago, right? I think 75 pre-market. What is that? $290 adjusted for split, where it was beforehand. I would have never thought it'd see 290. And if people, and who knows what happens tomorrow? If you remember last time, the stock went to 400 or 300. The stock went back to 60 over the next few days. If you remember that, this week, and then it went back to 400.
Right.
People always talk about that big move down. So who knows? We'll see what happens tomorrow. But if you sell some out of the money calls right now and you're up on them and just a few dollars left on them, I think you should probably cover them and don't try to make that extra $1 on it.
Yeah. And so you said you're short the stock. What price was it trading at when you opened your position?
Oh, I was just these are smaller positions. I was everywhere from 40, 50, saw pre-market, little bits. This is nothing, this is but by no means, I don't think any trader out there would be laying into GameStop.
So, Andrew, I mean, the story went back.
I want to one more question on the short side, right? So the price has obviously come down significantly. We're at basically $30 flat. Do you think there's still more room to the downside, or do you think that?
I mean, GameStop at $30 flat would be $120 if it didn't have the split, right?
Yeah,
which is still way above where my first cover was when I shorted the stock. And I think as we were talking when we spoke, the stock was 15, right? So the stock's up,
it's 15. When we started talking in 2021, it was 15.
So the stock's up 800% from what we started to talk, right?
Yep.
And are the business fundamentals any better?
Not really.
I mean, no, it's pretty much, even Ryan Cohen has said, okay, this story is over, right? Now I'm going to turn this into a private investment vehicle. So, if the stock went any higher, he'd probably be smart to raise some money, throw it in a few AI companies and spin a whole different story, see what happens.
So, Andrew, back in 2021, the media narrative and what was depicted in that Dumb Money movie and whatnot was that it was the small guy versus the suits, the big hedge funds, and it was this kind of David versus Goliath thing. Do you think that was an accurate depiction of what was going on?
Oh, definitely not. I mean, I definitely not. I mean, I think more likely than not, there was some kind of algorithm on the long side of it. I think, the market's matured since then. And I mean, as far as I know, I think Gabe Plotkin, I know he owns a basketball team. Steve Cohen owns a baseball team. Ken Griffin owns half of Miami, along with every other major metropolitan city. So I think the big guys are still doing okay.
Right.
I don't exactly know what Boo Boo Kitty owns, but I don't think it's a team.
Well, that was what was interesting was because I think when you look back on it, it was like who made a lot of money off that whole thing. And it was still a lot of the big hedge funds and the market makers, Citadel, obviously. And then, most retail investors that got in and bought GameStop at some point ended up, I mean, a few made a lot of money, sure. And Roaring Kitty's life, changed forever. But I think most people.
Well, Aaron, I sold GameStop pre-market in the 2021 for $420.69. Great.
$420.
Yeah, $420.69.
And you were good for you.
That was a lucky ass trade. I saw it pre-market. I'm like, it could hit that 420. Let's throw it out there.
I mean, there were some stocks. There were back in the day, and the option premiums were pretty juicy. This week, the $50 calls I saw them trading at $15 that were expired tomorrow. So that was pretty. We got pretty juicy.
Yeah.
So last question on the GameStop front for now, before we move to some of the other positions in your book. I mean, looking back on what happened in 2021, how has that reshaped or changed the landscape for short sellers? Do you think short sellers are now like more cautious about putting big short positions on companies that might be highly shortage?
Of course. The main thing is people understand the gamification of the market. The irony is that the gamification of the market, people start to understand it with the GameStop stock. It's been gamified for a while, and hedge funds have known how to play short squeezes. So that's nothing new. But yes, I mean, it changes everything. It changes how when you publish, what you're going to publish on. It changes the whole dynamic of short selling, of course.
Got it. And then you took a break from short selling after that, fiasco, correct? Did you get back in the?
It's just not worth it. I mean, if you look at the risk rewards of being an activist short seller, I've written a few stories, but the risk rewards aren't there anymore. I mean, first of all, the negative rebates, you can only make so much as a short seller. As you know, the regulators, the companies, the shareholders. So there's so much against you. Isn't it easier right now in this time and place? And by the way, the competition, there are so many activist short sellers right now. I mean, for, I guess, 18 years, I was the only one on the block, and it was great. But now, why not go look for undervalued situations? Why not look for asymmetrical opportunities in the market? That was the whole idea, is where do I see an asymmetrical opportunity in the market? And a lot of times it was through short selling. But right now, because of Twitter, X, because of all the activist short sellers, there's a lot more information out there. So it's very tough to get that asymmetrical information on the short side.
Okay, and so I'll ask the audience if you could give this interview a like, give it a share. And Andrew, I'll ask you, what's different on the long side, right? There's this wealth of information. You've got 10,000 gurus. You can't scroll down Twitter without somebody self-proclaiming as an expert. So how do you think about the long side differently than the short?
100%. I think you have to look at what's different on the long side. So there's two things. I mean, the last thing's another person to comment why you should buy NVIDIA. Although I put out a tweet today about Alibaba, I was totally blown away. I follow Open Compass, where it ranks the artificial intelligence, ranks the quality of them amongst the different ones. And you'll see that Alibaba's native one in China is really taking a lot of the top spots. And as you saw with the Microsoft news today and China, it's obvious China's going to have their own native tech system that's so behind on cloud. And then somebody said to me today somebody just recently, a hedge fund friend of mine said, do you think Amazon would give away 8% of their business to own all of Alibaba, 8% of their market cap? And I said, of course. Well, if that's the case, that would make Alibaba a double to show you how undervalued Alibaba is.
Okay,
but everyone kind of knows that story. And yesterday, Tepper came out and said he was all in on Chinese tech. What makes that unique and interesting is if you look at the valuations on China over the past 4 years, there's so much catch up in that space.
Right.
So it's catch up as in catch up, not ketchup and mustard. And it's been beaten down so badly. So, but again, I can't really generate any new information. What am I really adding to that conversation? I'm adding my opinion. But then you get something like, let's say earlier this year, I did a GEO.
Private prison.
The private prisons, exactly. And I started to write on the stock when it was like $8, maybe in the sevens. And now it's maybe 13.5, 14. I definitely think the stock's going to $30. I mean, they do the job that nobody wants to do. But what's amazing is you saw the migrant crisis happening. They own prisons and they own detention centers, and they have the exclusive contract with the government for alternative to detention, which is on your cell phone for migrants. They can check in, and it's a multi-billion-dollar contract. The thing is, nobody was really covering the stock because after the Biden administration tried to do it with all private prisons and the ESG movement against owning these type of companies, it was just left for dead. So here we are, a monster news story cycle about the migrant crisis, a company that's a direct beneficiary of it, and nobody was paying attention. It was a perfect setup for me to go out and say, oh, look at this unique situation.
Yeah, and I know Michael Burry was in that stock as well. I don't know if he still is. What about other positions in your portfolio, Andrew? I know you covered a stock in the AI space you like recently, and I mean, that has been the story of the year. Is it Edgio?
Okay, so Edgio is interesting. It's in the edge computing and the content delivery network space, and yes, and for AI. So they had a terrible past management. And if you look at, they kind of ran the company to the ground when it came to keeping them up to date on their financials. The company, I think it has a market cap of like $60 million. They're going to do $500 million in revenue this year. Their customers are Amazon and Microsoft, and they're late on filing. But they just brought in a new CEO. He's from Amazon. They brought in all new top tier management. And I spoke to the management, and they have a clear path. You can read the CEO's letter. And I mean, you see where streaming is going. Every football game and basketball game is going to be streamed in the next 2 years. They're the ones who do the streaming. This company streamed the Super Bowl. Okay. They were one of the companies behind it. So their competitors are like Akamai or Fastly, but they're trading at like 0.3 times sales versus like Akamai that might be trading at like 3.5 times sales, 0.3. So I have no doubt this company, again, is trading maybe $9 right now. But I think they're going to get the financials filed and people are going to see their prospects. And I think the stock goes to 30. And when it goes to 30, it's still cheap. Because what's amazing is when you find these companies that have done reverse splits. I mean, look at Root. If you saw Root just went from like 8 to 90 off Carvana, obviously an offshoot. But sometimes these companies, they go and they split that stock reverse, and there's really not a float out there. And then once it happens, if they start proving their business model, and we're seeing now you're able to cut expenses and in a lot of companies and revise their model, bring in good management, and the stocks can move.
Wait, hold on. I want to stick on this one for a second. So you said it's going to do 500 million in sales. It's got a $60 million market cap. Like make that make sense. Why is it so heavily discounted?
And I think 30% of the stock is 30% of the complete outstanding shares. I think are owned by like Apollo. So there's really no float out there.
Okay. And like, is the late to file the reason why there's been so much pressure, or is it just? I mean, 500 million is a decent amount of revenue,
and it's not even going to be. By the way, and I think 20%. I'm pretty sure I'm saying that maybe more than 20% of the revenue is Amazon, Microsoft, and one other big one. And they didn't leave them when the company went down to like 10 cents, 15 cents. They stayed around as customers. So this is a company, you have a real company, they sell real security products, real CDN delivery networks. It's a real company, and the stock price is no reflection of it. They just have to go ahead and get their filings. And they brought in a new chairman, new CEO. Just go read on the company, you'll say, wow, once this company, in the next year, let's say, and then they're going to sell themselves, in my opinion.
Is there secondary risk, or is the balance sheet okay?
Well, they have right now their balance sheet's fine. They're not raising money. Lynn Rock, Cynthia Paul gave them a fair amount of money. They'll have to recapitalize that because it came at a high rate, but that converts for her over $50 a share.
Okay.
And I think they'll definitely want to convert that over 50 a share. She will, her best interest in it. So there's no reason in this space you're not going to see consolidation. I mean, streaming is, when you say streaming is the future, it's live streaming, different than what we see on Netflix, obviously, right? Yep. And you're seeing that through obviously baseball, basketball, football, and there's companies that have to deliver it. And it's edge computing. So edge computing is, instead of having to go back to the network, go back to the cloud, how do you keep all the information on the edge? Allows things to happen faster. And yes, they are a leader in edge computing with those revenues, with those clients, and the market cap is that small.
Okay. Is this a smaller company than you would typically go after, Andrew? And if so, like, how do you find these kind of sub $1 million market, $100 million market cap companies that you find interesting?
What I've been doing recently, an interesting thing, and if any of your readers have one, please email me. I'd love to see it, is you find companies that have been left for dead, really. And their stock prices are down, and they had to do reverse splits. So now the float's really tightened up. And we're seeing now that companies learning how to be more efficient. Companies know how to do layoffs now. AI is allowing you to take the place of many of employees also. And you're finding new avenues of revenues through AI as well. So you might find a company that 2 years ago was just left for dead and then realize, wait, what's going on? They've been increasing revenues. Their customers are staying around. They're more relevant now. And where's their stock price? And that's when you can see doubles and triples. What good? Am I going to buy NVIDIA here and hope for a double? I mean, should have bought it 3 years ago and sat on it, right? But it's like, where can I find new information in the markets? And most of these stocks that we're talking about don't have great analyst coverage, or more importantly, the analysts have been so burned on these stocks, like Edgio. These analysts over the years who were bullish on them, been so burned over the years that stock's gone down, they're gun shy to say, oh, now it's a time to buy.
All right, I've got one I'll send to you after the show, and I want you to take a look at it. What about Jamia? What was that? Jamia, the e-commerce play of, where was Africa?
Amazing, yes. I'll tell you. 5 years ago, I came out. I thought Jumaya's books were wrong, fraudulent, cooked. And it turns out they were. I was right. The stock went from like 30 to like 2 or 3. And then I thought, wow, look at management. They're really trying to do things. And during the boom of like 2020, 2021, the stock went all the way to 60. Or maybe it's 70. It went that high. And now it's back at 6. The CEO just did an interview yesterday on Bloomberg. I encourage everyone to hear it. This guy has done the most amazing job in the world. I cannot believe that this company is breaking even right now, delivering goods and services in Africa. You know, there's two parts of the story. I own the stock. I bought more of the stock. I will continue to own the stock. If tomorrow someone like, you name it, Amazon, Walmart, Alibaba, SoftBank, Shopee, I could probably name you 25, 30 companies who would love to have exposure to Africa. The youngest population, fastest growing, tech savvy in the world is in Nigeria. You can't teach the amount of size of people they have. Jumaya has made all the mistakes already. There is no number two. They are a clear number one in this space. Market cap's 500-600 million. Market cap will be much higher than this in the coming years. What I believe happens with Jumaya is eventually we're going to wake up and see they sold 10% of the company to one of these names. No one will buy them. I think in Africa, you're always going to have a native company and own what they have going on there. It's pretty spectacular. Just go look at the past 2 quarters and you're amazed. And it's all been under new management.
So you went from having like a bearish out view on this stock to now being long it. I mean, that's got to be like the biggest stamp of approval ever.
Well, when they had their IPO, the numbers they just weren't right. It wasn't kosher. It just wasn't right. And had to flesh it out. And then I've been bullish for a while, but then I was wrong because I realized how difficult e-commerce is. I'm like, well, if e-commerce is difficult in the US, imagine how difficult it is in Africa.
Right.
And then I realized, then when the new management comes in and said, okay, we can't deliver it to your door anymore. Fine. We're going to deliver to, think about when you deliver to a door. Someone has to be home. It needs an address. All those are big problems in Africa. Okay. So let's just start delivering to certain points. Now let's go find our unprofitable countries. Let's cut them out. Let's find out where we're making, we're profitable. And let's really fine tune this business. And that's what they've done. They've really it's not easy. They have a very difficult business and they found out a way to do it. And again, so they are the player for e-commerce in sub-Saharan Africa. And I think their market cap's 550 million. And so the argument with this company is they're going to go bankrupt. But now they're not going bankrupt. They can break even right now. They slashed marketing by like 80%. Imagine slashing your marketing by 80% and still growing revenues. And that's what they did last quarter.
All right, Andrew, let me ask you out one more as we're coming up on time here. You were previously bearish on the crypto market. I think it was earlier in 2024. You said you were long Bitcoin, short Coinbase as sort of a pair trade. Where do you stand with crypto?
Oh boy. Now when I talk about pizzas, I talk about this. People just go bananas, so crazy about crypto. All right. So here's the story with Coinbase. I still look at Coinbase as an exchange, and I don't really understand. I'll be honest. I don't get it. The stock is a stock and the market's telling me I don't get something. I don't get a lot of this. I get Bitcoin. Doesn't mean I don't believe it's
like when you're saying you don't get Coinbase, it trades at too high a multiple versus what the revenue's worth, or what do you mean?
I just don't see why eventually. Okay, if everybody holds on to their Bitcoin, it doesn't sell anything, and we get rid of all the shit coins, right?
Okay,
where's their business? I'm just not getting in that. You know what I'm saying?
Mm-hmm.
And where's the multiple? Where's the growth there? Let's get rid of all the shit coins. Let's just talk about because I don't believe in the shit coins. Altcoins, shit coins. Email me. I'm sorry. I offended your personal coin people. Okay. So, so right now, I probably shouldn't talk about it, but why not? Because it is what it is. I'm long Bitcoin and I'm short Ether. I think Bitcoin, I think if Bitcoin goes down 20%, Ether will be down 30%. I think if Bitcoin's, up 30%, maybe Ether will be up 20%. But I'm very cautious, obviously, about, I try to learn from my mistakes. Where have I lost? Where have I made? And what can I not control? It's tough. When you get in the world of crypto, can we wake up tomorrow and Bitcoin be 42,000? Why not? Why not, right? Can we wake up tomorrow and it be 80,000? Sure, why not? Well, how much money can I really dedicate towards that? Right? Yeah. But if I find a good pair, I also believe Ether will be labeled a security short term, or they won't get the stamp of approval so fast from the SEC. And also, I just don't see the utility in it. I understand the concept. So call me a Bitcoin maximalist, if that's how you'll be it. Don't love Coinbase, don't love Ether, but I like Bitcoin.
Awesome. Andrew, any final thoughts for us?
That's it. Love to hear people's ideas. Email me, Andrew at Citron Research. Let's find some new and interesting ideas. It seems like they talk about the same stocks every day on CNBC. I can't hear it anymore, right? Everyone knows what to do. We all know about the Mag 7.
Yeah, wait. We're not going to talk about Amazon or Meta? Okay.
Yeah, exactly. Enough, right?
All right. Well, I told you, Andrew, I've got one I'll hit you with after the show. So
I look forward to it.
I'll shoot you an email and we can talk about it a little bit. But again, thank you so much for hopping on with us. We'll reach out to you, bring you on again soon. And
sounds great, guys.
Talk about your book some more.
Have a great day.
All right.
Take care, Mr. Left. All right, guys. That was Andrew Left from Citron Research. Always a fun interview. Now, on the other side, we've got someone who at least used to be bullish on GameStop. I don't know his current outlook, but we're excited to bring on Rod Alzman, the founder of GMEDD.com. Without further ado, let's go ahead and welcome. What up, Rod? Let's get straight to it. How you been doing?
I'm all right, guys. How about you?
Good. Thanks for being flexible, by the way. I know we kind of pushed back the time a little bit and rescheduled, so I appreciate you working with us there.
Yeah, sure thing. I wanted to real quick go back to Andrew was talking about stocks off the beaten path, and he mentioned the ongoing trend of people coming into the country, and he noted Geo, which has over 10,000 people following it on StockTwits, for example. I like a business that benefits from that trend. It's a remittances business. There's 85 followers on StockTwits. It trades far more cheaply than Geo, and it's catered every line item up and down the income statement in the double digits over the last several years. So International Money Express, it's a small cap financial. People hate small caps. People hate financials. So that's the type of stuff I'm always looking for. I loved GameStop when everyone hated it. I don't like it so much nowadays, but again, that's just the way the world works.
So let's start there, right? Reaction to Left in what Left was saying about GameStop. He said that he short the stock again via options, which I don't think we've known before that interview. What's your reaction to what Left had to say?
Yeah, I saw Bill Gross wrote a straddle. He wrote the $40 straddle, and he generated 22 in premium on that straddle that he entered on Tuesday for the weekly straddle, right? So stock trades below 62 or above 18. Mr. Gross is doing all right. That's the sort of opportunistic way to participate in these bouts of dislocation, whatever you want to call them. Getting outright short, obviously you have just a different risk profile. When implied volatility, Luke, in Jan 21, of course, we talked about it during that crazy week, right? Yep. When you get implied volatility, pushing up on 4 digits, you should be selling volatility opportunistically and understand your risk profile. If you have a smaller account, you probably shouldn't be doing that. But if you have a smaller account, there's other ways to make money in the market that doesn't require any risk. And we can talk about an example of that. But yeah.
Rod, not to bore everyone, but how much fun was it in 2021 when we were talking every day? And every day was
it was crazy. Honestly, it's weird because that's not really my style. I'm boring. I like, Andrew mentioned ESG. I love the ESG stocks that people sell off. Like my largest position is British American Tobacco. I'm pretty boring. I'm trying to buy discounted cash flows more cheaply than I think that they are worth. And look, fundamentally, if you're buying GME or AMC here, I don't think you can make any justification that there's a margin of safety or that there are future cash flows coming to you that can justify the risk you're bearing. It's that simple.
All right, and you alluded to GME. You said you liked the stock, but you don't like it so much now. Where are we at with GameStop?
Look, it's a convoluted thing for me. I don't know if I shared the story directly with you guys, but I've shared it before. Like when I was in my early teens, it was the first stock I ever bought in the early 2000s when I was in high school and made some money off of it. I got back into it in late 17. I lost, a lot of money over the course of 18 and 19 buying more of it. I was down from my initial buy like 80%, and on my weighted average, buy trough pricing in COVID, I was down 50+%. And it was the majority of my portfolio. So, it was a very painful multi-year experience, but at least from a analytical perspective, it didn't make sense to me, certain aspects of it. And what it really highlights to me is how reflexive markets can be, which is, I know, something that Keith used to kind of talk about. I know he's a fan of Soros, so maybe some of this is just his own way of seeing how markets can react. But he was talking about tokens and crypto earlier, and I would argue that a lot of these securities, that equity securities, they're more akin to trading tokens than they are to any connection to the underlying business.
Got it. So, I mean, for you as someone who comes from more like the fundamental school and the value investor, like to see them trading this, disconnected from their valuations probably makes your head spin a little bit, huh?
But the nice thing is you don't have to participate in stupid games, because if you play stupid games, you're going to win stupid prizes. So while it's shiny and flashing lights, and I've certainly been distracted this week myself, I haven't transacted in any of the securities. And the thing you should do is turn it off. You guys may not want me to say, turn off Benzinga, turn off CNBC, whatever, but do actual due diligence, read some financial statements, look at stuff that other people, I would agree wholeheartedly, you want to fish where no one else is fishing. And you certainly don't want to fish where people that have the best damn fishing poles that money can buy are fishing. So get out of the stocks everyone else is talking about if you're trying to be a more active participant. And really even step back further. Most investors will be far better suited really starting from the basics. Make sure you have your financial book in order. Make sure you're not carrying high interest credit card debt. Make sure you're optimizing your savings. You're saving in the right tax advantaged accounts. The blocking and tackling has to come first. This stuff is all beyond that, but for too many people, this is the only thing they worry about, not the blocking and tackling.
Well, not to bring up, I guess something, I don't know, something you might not want me to bring up, but I know at one point in the past we had discussed Playboy as a stock you liked. What, I guess, looking back on it, do you think
you don't have control? You can't trust. And, for one, when I realized management was not to be trusted, it didn't matter that they were on the record with multiple large investors committing to actions that they then didn't take. So if you don't have control or a means to take control, unfortunately, Ben Cohen swindled a lot of people, myself included, and he won't bear much repercussion. He'll continue to collect his salary.
So it's just there were some things going for the company, but the leadership team was not a team that was going to deliver that value to shareholders.
You should ask Ben what he's doing to deliver value to shareholders, because his commitments to investors were broken time and time again.
We haven't had him on the show before.
We had him on the show in 2021.
Ben Cohen, right? Is that Ben? What's his name?
Yeah, we should bring him back on. I mean, there's a
He'll decline. He's a pussy.
Okay. All right. Well, Rod, any other stocks? I mean, we know you as kind of the GameStop guy. You mentioned the British American tobacco. Any other stocks right now that you're viewing as deeply undervalued?
There's been, again, think about trends and narratives getting far ahead of themselves. The EV narrative was all encompassing for the last several years, and we're starting to see people pulling back a little bit from that. So what does that mean? Well, you have a lot of companies that provide componentry to internal combustion engines that have been written off, or that saw their multiples materially derate over the last several years. So stuff where you have oligopolists, I have an MBA in competitive strategy. That's the stuff that excites me, is when you have advantaged businesses that are trading like they are not. So stuff like Allison Transmission, Garrett Motion, making turbochargers, making automatic transmissions for internal combustion, trading at single-digit earnings multiples, aggressively repurchasing stock, with a levered balance sheet. That stuff's pretty attractive to me. And I think that's stuff no one cares to talk about. I also have the experience of working for several years in corporate strategy at Ryder, and literally spending years of analyzing the likely evolution of EV and proliferation in medium and heavy duty commercial vehicles. So stuff you should invest in. If you don't have any insight into the industry, maybe you should steer clear.
And then, I think that's good advice, to just stay clear if you feel like you don't have an edge. Who would you say, I guess, is kind of inspiration in terms of value investing and looking at the fundamentals? Is it more of a Buffett, Michael Burry? Who do you look at as someone that you would like to emulate?
there are attributes of a lot of those investors. I think what I would just say to that is you need to know yourself and you need to invest for yourself. And if you're not someone who could, you shouldn't follow someone else's strategy or way in which they do things just because you respect and admire them. You need to deeply understand yourself. I was comfortable buying more GameStop over the course of 19. I was literally on a family vacation in Hawaii a couple of days before Burry wrote the board, saying, hey, execute the balance of this buyback and repurchase 80% of shares outstanding. So like, I know I was buying calls for Jan 21 in August of 19 because I knew the console cycle was coming. I knew that disk drives would be present on the consoles, and the narrative had gone way off the deep end about the company not even surviving to that cycle. So you want to definitely look for this. I think a good like hunting ground is find the stuff everyone hates that's trading deeply depressed, and then what could happen that would just simply change it from we're going out of business to, well, I mean, again, that works for me. I'm not a growth oriented investor. I can't say I know what the world's going to look like in 5 years, right? 5 years ago, no one, I think, would have had any sense for where we are in 24, looking back from 2019 vantage point. So
Right.
It's hard. You want to buy with margin of safety. You want to do your due diligence, but there's opportunities in the market for smaller, I'm sure a lot of people in the audience have, their accounts not got 2 commas in it. And there's opportunities like odd lot tenders. I made a comment about the Cummins Atmos tender in the first quarter, for example. In a tender offer, when there's an odd lot preference, you get to jump to the front of the line. You don't have to deal with proration. So in that case, a small investor would benefit more from a percent basis, but buy 99 shares of Cummins, tender your shares. You basically got a risk-free $2,000 or so. You could have hedged some of the risk you'd bear from a timing perspective, but that one, if you had the $27,000 or so of capital that it took to buy, right, $2,000 for a week or two of having your shares tied up, that annual IRR is wonderful. If you keep just pulling it down these odd lot tenders that are effectively risk-free or hedgeable risk. So I think my thing is that people have seen for 15 plus years now, just as Howard Marks would say, for example, this excessive risk taking has been rewarded. And people then just keep taking more and more risk, hoping for more and more reward, but they kind of forget that when you do take that risk, you're not assured the return that you're taking. So I think people generally are taking on too many risks. For example, I added 50 basis points of Q's hedges for Jan 25, thinking, well, if VVIX is at historically low levels, VIX is pretty depressed. Left tail risk seems underpriced with equity indices at near all-time highs. So everyone thinks stonks keep going up. Why not hedge yourself a little bit? So again, I'm just a contrarian by nature. I don't like to say the word, because if you say it, it's like, are you really? But like, just got to do what works for you.
How much money do you spend, or do you suggest spending, I guess for you personally, on hedges? Like I've lost so much money over the past 5 years being the guy who hedges with SPY puts or something along those lines.
I told you not to that time you did it, remember?
I've done it a million times and I've gotten fucked
I keep telling you the S&P 500 just keeps going up and you keep buying puts and then it keeps going up.
So how do you think about
that? Right. I mean, you just have to size it in the context of your portfolio, right? You shouldn't be, a hedge shouldn't be, 20% position size, right? It should be, single digit, maybe, low single digit percent. And like you kind of got at over those 5 years, most of the times those hedges have expired worthless, but there were a few times that you made, multiples of your money on those hedges. I had some puts, for example, in Feb 20 that did quite nicely. And the great thing that, if you followed Bill Ackman, is that when then everything is cratering and there's a ton of fear, you can then monetize those positions. Those hedges now become a source of cash for you to opportunistically be a buyer when fear permeates. I mean, you want to buy when everyone is scared, and it's so much easier said than done.
Yeah, I mean, you take a look at a stock like Alibaba or something like that. It's like, oh, it's $65 on the low end. It's like, oh my God, this thing's so ugly. And now that it's back up at 85, I'm like, why isn't this the biggest position in my portfolio?
And I heard Andrew refer to Tepper, and it's like, okay, as of March 31st, that was his position. But now the 13F has come out. The stock's run, 50 whatever percent over the last month or so. And that guy may already be out. I mean, 13Fs are okay. They're a source of information, but understand that's delayed information. And it could have changed the day after it, the quarter ended.
So, Rod, I want to go back to GameStop real quick because I find this story very fascinating because there's such a divergence between the two sides of like investors that were like yourself buying in 2019 because of this underlying value. And I remember at the time I was working, I had like an internship at an RIA, like a little independent advisory firm. And this kid I was working with was like, dude, you got to check out GameStop, and walking me through all the valuation. And he was very much like a Burry-esque, and Burry at the time was in it. I think that's why this kid got in it. But he was reading me stats about, and I remember the one that stuck out.
Burry got in 18, he got out, and then he got back in 19 after the dividend cut. Just, again, irrational things happen in markets. What's been going on this week isn't rational. But you have these narratives that overwhelm in both directions. And when they cut the dividend, for some investors, it forced them to sell, right? So it led to that wonderful opportunity in late 19, or summer 19, excuse me.
But I remember one of the things this kid told me at the time was there was a stat out there that like 96% of video game sales were now online, and that was bad for GameStop's business. But it was including mobile apps and like phone games, and that once you took that out, that a lot of people were still buying physical games. So like he had this info and was like, you got to buy the stock, all this stuff. And you had people like that and yourself that were in it from the fundamental value perspective and like understanding the story. And then you had all the people that bought just because it was going up and because Roaring Kitty was in it. What to you like initially drew you to it? I know it was your first stock you ever hold, but like, what were these fundamentals being talked about in message boards? Like, I just want to know how we can find the next one like that.
I literally got on social media in 2018 for the express purpose of identifying like what is a rational bear thesis other than the simple narrative of what you just said, that console, the physical video games are going away, which, yes, that has been a secular trend impacting them for over a decade now, right? The first GameStop is Blockbuster headline I think I saw was like 2010, 2011. It's not a new narrative. And your point about that, I think, is vital, though. People will see a data point, 97% of net video game sales are digital. Without the context of you need to slice and dice that market. There's mobile video gaming, there's PC gaming, there's console gaming. GameStop chiefly operates in the console gaming segment. PlayStation 5, it became known to market participants in 2019 that it would have a disk drive. Same with Xbox Series X. So that kind of led me to believe that they would, based on their balance sheet and income statement, they would be able to get to the next cycle. They'd be able to generate cash over the cycle that we're in, and that it was more of a cigar butt type viewpoint, right? Yeah. So I think when you hear data points, do your own due diligence. One of my jobs out of grad school was competitive intelligence, and doing deep dives of like CI into, read what the companies are putting out, read what adjacent companies are saying, read their blogs, like develop an in-depth understanding of the space that you're participating in, and don't just accept narratives at face value.
And so, Rod, I want to ask you one last question and just bring it back to the beginning. You've talked about how you invest, the type of stories and situations you look for. For the GameStop story, what would you want to see to make it interesting for you again?
It's a math problem. Mm-hmm. You have a company that the people who are optimistic about, again, like there's a difference between the stock and the business. Yep. So the business is still facing those structural headwinds. The top line number is still in decline. That said, they're taking steps to improve gross margin by improving sales mix, by taking cost out. That is also taking cost out on SG&A. There's only so much you can do to grow operating income, though, when that top line is facing kind of the challenges that they are facing. I would say if you're interested in like better understanding gameplay, you need to look back at the 2018 annual report. The 10K breaks out. They had like 6 different categories in that one, which shows you that like the bulk of their gross profit was coming from pre-owned games. And there are inherently no pre-owned, physical discs to sell to customers as that digital mix continues to rise. So that kind of headwind still exists. In the accessories piece, they've launched a white label product recently that's gotten some decent reception. For example, just over the last week and change, there's been that they will begin to accept graded Pokemon cards in store trade, and that they will then resell online or whatever. Like, there's logical adjacent businesses, collectibles they've been trying to grow. But like, for me, enable in-store grading. You drive foot traffic, you can generate some revenue off of that business. That's something that does require a physical presence, or at least if you're trying to eliminate all of that e-commerce cost. It's like, there are logical adjacent businesses, they can grow, but here's the issue. I don't know what it's trading at, whatever, call it $30. You're paying a massive premium today for that. I would happily own the business if I thought I had a margin of safety, but to me, that would be much closer to the cash on hand. And it's just a math problem. Like, even if operating income grows to 100 million in a couple of years because of their success and sales mix improvements and cost takeouts, okay, 100 million in OI for a retailer that still has those challenges, 10 times, 12 times. Okay, so that's a billion, 1.2, add the cash. I mean, that's still just a lot higher than where the stock trades today. So, if you're investing for the meme, or if you're speculating for the meme, that's one thing. But if you're trying to buy a company at a acceptable rate of expected future return, I think you just have to stay sidelined and await it to come to your entry price, and don't just chase things because you get hyped on some memes.
Yeah, I wonder, I mean, to your point, like, if I was feeling nostalgic and I wanted to go buy like Game Boy Advance and go play like the old Pokemon
they sell those games.
Right. Like, so, but would I go to GameStop, or would I just like look on eBay for it and buy it there? I think like GameStop
the prices are pretty comparable. I mean, granted, you might find a one-off, right, from a single seller. Obviously, then some of the value of the GameStop transaction would be dealing with a large company that, if you got a counterfeit version or whatever, you'd have more recourse. But yeah, they've done some of the retro gaming. I mean, there are other non-GameStop branded companies that have local stores throughout the nation, card shops and the like, that sell those sorts of things. So they tried to lean into e-com in like 21, and seemingly have now very much pulled back now. Yeah, they closed the fulfillment centers that they had opened. They shut down the US-based service team that they had set up. So I see it now, like, from what Cohen had this memo to staff that got leaked late last year, that I think he was in retirement, right? He came out, this craziness happens. I think he's committed to this as his thing, insofar that he wants it to survive. But what I was saying in Discord to folks last night was like, what they need to do to be successful over the long term is to be opportunistic when opportunities in the market present themselves. Like right now, they should be selling stock. And they should survive, because if the economic environment deteriorates, they are going to likely consume some cash that they have in their balance sheet. And then they need to snipe. When companies are in distress, if you get, Funko hasn't been doing great. If a Funko, went into a Chapter 11 restructuring, does GameStop show up to the auction as a bidder? Like, I think he will be balanced and measured, even if his persona is different than that, with the company's capital. But that's not exciting, and that's a very long-term thing. And right now, people are willing to pay this massive Cohen premium. I'm not willing to pay that premium personally. I understand why some people may want to, and he has a lot of attributes that they admire, and I do too. But again, if you're making an investment decision, you have to let it be informed by the numbers. And yes, there are other elements too, but that's just the way my brain works.
All right. Well, Rod, I know we've taken up a lot of your time already, so we're going to go ahead and let you get on with your day. Before we let you go, what does your shirt say? We like puns over here. I want to know what your puns are.
You see the koala?
My puns are, I don't get it. Am I missing something?
It took me a second.
I
koala,
got it. I hit. Koala tea. It's a koala drinking tea, like quality.
Oh, okay.
And it's a koala
t-shirt. Yeah. T-shirt. All right. I like that, Rod. All right. Well, man, it's always great to catch up with you. We'll have to bring you on again soon. Anytime you have like stocks you're excited about or any theses you'd like to discuss, you can just.
I share my positions on roughly a quarterly basis. Again, it's the more small cap, off the beaten path stuff. And like I said, with Intermex, 85 people follow that stock. a stock on StockTwits, 10,000 plus on Geo. I think Intermex outperforms Geo, but that isn't to say Geo is not a bad stock either. Just that there's a lot of interesting stuff.
Andrew Leff versus Rod Alzman once again 3 years later. Here we go. All right. Well, Rod, again, thank you very much for joining us, and appreciate all the work you do and bringing us some sound advice and like real knowledge to this subject that seems to be lacking a lot of that.
Oh, thanks for having me, guys, and good luck everyone speculating. I'll be watching from the sidelines. I'm gonna sip my quality.
There you go. All right, Rod. Take care. Enjoy the rest of your Thursday.
All right, you guys too, bye.
All right, guys. That was Rod Alzman, again, founder of GMEDD.com, doing some great work in the fundamental space. Really, searching for those diamonds in the rough that are undervalued companies. That's what we like. We love hearing new trade ideas. If you have any trade ideas that you'd like to discuss live with us on Benzinga, email shows@benzinga.com. Again, that is shows@benzinga.com. Make sure to CC Luke Jacobi so he can see them as well. With that, Luke, let's go ahead and wrap up our Benzinga Live today. That was a fun episode.
That was a fun one. 2021 throwback.
And more
happy trading, everyone.
Yep. We'll see you guys soon. Peace.